Factoring is a form of lending for businesses where the money is lent by a bank, factor or some form of lender, and it's secured against the money owed on your invoices, as opposed to a traditional business loan or overdraft where the bank would take a look at your company accounts and they would work out how much they're prepared to lend you based on the state of your accounts, but not taking into account the money you are owed and through issued invoices. With factoring, they actually look at the amount of money that you're owed by customers that have not been paid, and you can borrow money against that. The difference between factoring and invoice discounting is they're both forms of asset-based lending or invoice finance. In the case of factoring, the bank or lender takes over the issuing of your invoices and the receiving of that payment. It's called sales ledger management. In the case of invoice discounting, they do not. As an example, let's take a recruitment company that has a turnover of £500,000 and a positive cash flow of maybe say £10,000 a month and £40,000 in the bank, for example. They win a couple of new successful contracts with a big supplier or suppliers where they, as an example, taking temps and providing temp services. Now, temps are paid on a weekly basis, so the recruitment company would have to pay that £40,000 or the weekly equivalent in fees to the temps on a weekly basis, but the business they're providing the service for will probably pay the invoice 30 days after issue. So that creates a 60-day window in which the recruitment company is making a loss and will actually be in negative cash flow. Now, by taking out a factoring facility, they can secure lending against the unpaid invoices and solve the cash flow problem, allowing them to grow with the development. You can take that as one example, but there are many others. You can see the same applying to perhaps a manufacturer or a printer who have a big order they take on and they want to expand and they need to purchase the stock to enable them to deliver on that order. Or also it can be used by businesses looking to do management buyouts or management buy-ins as an alternative form of finance. It's very important to note what type of businesses qualify for factoring, because it isn't suitable for all trades and sectors. The most important point to consider is that does your business invoice other businesses? If it doesn't, then unfortunately it's not a suitable form of financing. A classic example that would be a retailer. If you're a shop and your customers come in and they pay at the point of sale, then you don't have any invoices that can be lent against. So wholesalers, on the other hand, that trade with other businesses and invoice on bulk can and are very suitable. Other classic trades are recruitment, transport, haulage, construction, IT, printers, manufacturers, etc., etc. If you're going to take out a factoring facility, there are several things you should consider and keep an eye out for. And make sure you discuss with your lender prior to taking out a facility. Obviously you want to know what the actual fees involved are, how much you're going to be charged. Do check around, see if you can get better rates from other providers. There might be quite a difference between the rates offered by a factor as opposed to a bank. But also check the levels of service. You're going to have a lot of regular contact with your bank or factor, and you want to make sure that you're happy with the levels of service they're going to offer you. Check to see if there are any exit fees actually involved with taking out the facility, and check to see how long the facility is. How easy is it if you want to stop using it, to actually how long you're contracted into.